New Fed data indicates hard landing. I'm your host, Steve Van Meter, and thanks for joining me today. In our lead story today, we have some shocking new information out of the Federal Reserve that shows the U.S. manufacturing sector is crashing at the fastest rate since 2008. We're going to take a look at the data and try to determine if perhaps this is indeed the bottom in the manufacturing sector that many are hoping for, or if it's about to get much worse. Plus, we have some other information now about the unemployment situation that shows underneath the headline numbers, the situation is far worse than we thought. And the banks are back pulling money from the Fed. We'll take a look at why they're drawing on these credit lines even more and why the Fed remains completely clueless to what's going on. Let's over to Zero Hedge, where we picked today's story up with a headline: Philly Fed Business Survey unexpectedly slumps to the worst since Lehman. And shortly after the Empire Fed Manufacturing Survey unexpectedly surged back into expansion, the Philly Fed Business Survey unexpectedly puked to its lowest since March of 2009. As analysts expected a rebound, but keep in mind, this is the 8th straight month of contraction, 10 in the last 11. So what we're seeing here out of the manufacturing sector is not something we really want to be seeing at this time, because what we're hoping for is the manufacturing sector will bottom and turn higher and kind of put an end to what is believed to be this soft pullback or mild recession that the Fed is hoping to engineer. But one of the challenges here, as a manufacturing sector continues to slump, what we should eventually see in the months to follow is the services sector head down, and heading into the summer months, which are big months for businesses who do a lot of volume and need this to get through the winter months, this is entirely bad news. And here you can see the worst since Lehman as Zero Hedge headlines in the Philly Fed Business Outlook Survey in the red, showing that it is back to, of course, crisis levels. And the question remains is this indeed the bottom? And you see going back to 2008 that what looked like a bottom. The question is, are we seeing that? The question I'm going to let you answer today. I'm going to continue on as we dig deeper into the survey. But what do you think? Is this just the beginning of something worse, or are we closer to the bottom than we think? Let's head over to the Philly Fed now and dig deeper into the report. As manufacturing activity in the region continued to decline in April, but keep in mind, this was from April 10th to April 17th. So this is very fresh, very recent data. The survey's broad indicators for activity remain negative, although indexes for new orders and shipments rose. We'll talk about that here in a little bit. The employment index suggests steady employment overall, indicating they're not really hiring and they're not really firing. Both price indexes continue to decline. That is your disinflation component, as they're not only getting less money for what they're selling, but input prices are coming down. But catch this, the future indicator suggests that firms' expectation for growth over the next 6 months remains subdued. So outlook is not even optimistic as well, although we keep hearing from policymakers and politicians that everything's a-okay and everything's going to look up. But again, I want to suggest to you, heading into the summer months, we need to see demand increase. Now let's take a look at the report, because I want you to see some of these numbers. And if you've never looked at these diffusion reports, keep in mind they represent the percentage. So these are firms that are interviewed, indicating an increase minus the percentage indicating a decrease. So on net, you see 22% of firms see a collapse in new orders. You see shipments are down, but they're better than they were the previous month. And this is kind of important, because you think about heading into the summer months, you think about your inventory needs, and those are going to start shifting. And I'll give you a really good example, because I live in the vacation capital of the world, and we have 2 Disney water parks here. One is considered the winter park, the other the summer park. So you think about inventory. Well, if you close the winter park, which they did, well, you don't need that inventory because it doesn't match the theming or the name of the summer park. But the challenge with the summer park, when you're trying to sell merchandise, well, you can't keep selling old merch. You got to have the new logos and new designs and new towels and new cups, all the new stuff to get people to buy. What we don't know is how much old inventory they have. But broadly speaking, throughout the entire economy, we know inventory levels are high. We know that inventory is old, but there should be an increase in demand somewhat heading into the summer, just as businesses retool what they need to sell to consumers. As we continue to look, we note the delivery times are falling. That is indicating that getting products out of the factory to consumers is happening faster. Inventory levels, those are going down. Prices paid are increasing at a slower rate. Prices received, that means that is disinflation. That's headed down. But notably, number of employees, and that's not moving anywhere. And the work week, well, it's still contracting, but not quite as much. Again, we talk about wages being important. Just because someone's earning a wage, if they're not getting as many hours, is still effectively a pay cut. The question we now need to look at in the manufacturing sector, are they about to do a heavier round of layoffs? Well, not according to the survey, at least so far. In terms of wages and compensation, these special questions, how's it changed over the last 3 months? Well, almost half the firms said there's really no change. The other half were planning to increase wages and compensation. But get this, since the beginning of the year, have you adjusted your budget for wages and compensation? Over half said no, they've not needed to, suggesting that manufacturers are happy with their staffing levels for the moment, and they don't see a need to pay people anymore until demand turns around. So the question now is, are we likely to see demand start to turn? Well, let's look at a couple of these headlines, because as we get into a deeper report into yesterday's unemployment data, what I want you to see is the overall health of the economy is not that great. But when we get into what's kind of underneath the covers of yesterday's report, it's going to surprise you. Here we see AT&T shares sink after company posts softer than expected revenue and cash flow. How about this? Tesla net income drops more than 20% from last year. How about now? Seagate hit by hellish third quarter, with worse to come as revenues, get this, were 33.6% lower than a year ago. So just from some of these headlines, you can take away that, well, perhaps, the worst is behind us. But if this is just the beginning of the downturn, and that's the case we started making in yesterday's show, when we talked about how these initial claims for unemployment were starting to tick higher. You can get a recession, around 250,000 of people out of work or making a new claim every week, not the 350,000 that we normally need to see. All this bodes to say that if we're in the beginning stages of a downturn, the worst is far yet to come. But in one place it shouldn't be. Well, of course, we note that CTA-Timer Pro report, we talked about this last Sunday. The regional banking sector was bottoming out. This report caught it faster than virtually anything there on the market. It's real simple. You see a -100, a -100, and you see the fast algorithms start to tick up. You take a position we mentioned in Sunday's show. Grab this. It's $30 a month before I raise the price. You'll see that trades up. We'll cover it more in detail on Sunday. But now let's get into the depths of the unemployment report, as top earners collecting unemployment benefits have surged a whopping 500% in the last year. Now, we said that this was eventually going to happen. Now, we were hoping it wasn't, because what we wanted to see is these people leaving these high-paying tech jobs were going to be absorbed in other places in the economy. But it's not. Now we're seeing that they're not being absorbed. But wait till you see what the response is when these group was interviewed about how they're managing their finances going forward. And here we can see this reflects, of course, white-collar layoffs, and filers in high-income households are getting more money. Of course, it makes sense. They made more, they paid in more. About 113,800 adults in households with annual incomes of at least 200,000 reported receiving benefits in the last 7 days. Remember, the claims were 245,000. So you're looking at more than half the people here, or about half the people filing, are high-income earners. Not really a good sign at all for the economy, because remember, during the pandemic, they weren't the ones that lost their jobs. Now we're seeing that they're ones on the top of the list. And that's up from a little 18,100 a year ago. So you can really see the high income earners are taking a hit. And among roughly 1.4 million who reported received benefits in the last 7 days, 84% of them said they supplemented the government assistance by taking on, get this, more credit card debt, spending down savings, and that included withdrawals from retirement accounts, something you never want to do unless you really are desperate, or selling possessions to meet their needs. So think about this now. What's going to happen when people can't use their credit card anymore, when they tap it out, or as the banks say, you know what, we're not going to keep increasing your limits here? What happens when their savings goes down to nothing? What happens when their don't want to withdraw any more out of the retirement accounts because they find out what the taxes and penalties are. What's going to happen to these big wage earners is their spending is going to come way down. The problem is it tends to be the more money you make, the more you spend, which could be, as we talked about in a show earlier this week, repossessions and automobiles are likely to tick up. What could happen here is we could see it in high-end automobiles, which is typically what high-income earners tend to drive, because they're going to have to make some hard choices of what to get rid of in their expenses if they can't get another job, or if they can but not get a wage anywhere near what they need. And now let's take a look at how this downturn in the manufacturing sector is going to impact, of course, the unemployment claims. And it should be obvious, because what we're going to see here is the current new orders for that Philly Fed, the data we just looked at. And mind you, we saw a little slight improvement in new orders, but it's not a broad improvement against the 4-week moving average of initial claims. And I want you to see is where the blue line kind of heads down. You notice the red line, which is the 4-week moving average of initial claims, moves higher. So you can see broadly a slowdown in demand of new orders, eventually an uptick in unemployment claims as employers don't need as many employees because they don't have demand. We see that repeat over and over and over. And now, unless we see a big turnaround in initial claims, or not initial claims, but in new order growth, well, we're not going to see these initial claim numbers go down. We're going to likely see it go higher. And if we see people spending less money, that will then in turn to less demand, less need for employees, and you can start to see this thing snowball, and you can even see it turn into a decline in retail sales, which we've also made the case is when that happens, you certainly need less people if you have less demand coming into your store. Here you see the same effect, new order decline. Then with a lag, you see retail sales fall. And I've drawn the baseline for retail sales here in green because it's shown on a year-over-year rate of change. And notably, we saw a kind of rare contraction in that during the global financial crisis. Of course, we saw that during the pandemic. And now we're headed to that again. And we're still in the early stages. We're not even in a recession yet, according to the government data. And we're still in the early stages of a decline here. And I think it's going to get a whole lot worse. And as we look over to the banks, well, some reason they're back and increasing their draw off of the Fed's emergency credit lines. Well, let's take a look at what they're up to and why they're back taking money. The Fed's emergency loans to banks supposed to first rise in 5 weeks. So just so you understand, what happened is these banks came in, took a whole bunch of money, and they started paying down their credit lines. Odds are they probably took more than they needed, not knowing. And as things kind of smoothed out, they started paying back those credit lines. But let's take a look at what's going on here. And what we see is the weekly Fed balance sheet data showed $69.9 billion of outstanding borrowing from the central bank's traditional backstop, otherwise known as a discount window, compared to $67.6 billion the previous week, and the record $152.9 billion reached last month. Demand from the new bank term funding program, which is where you swap your treasury securities for cash, also climbed, rising to $74 billion compared with $71.8 billion the previous week. So going into this last week, we saw a decline in this, obviously a little uptick. Part of the reason could be due to tax filing. Banks were a little nervous that perhaps people needed to pay their estimated taxes and their tax bill, and so they brought in some more cash. The question we'll look for in the weeks to come, is this sustainable? Are they actually then going back to paying down those credit lines, or are we still seeing stress in the banking system and deposit flight where they're taking out more money? We just don't know yet, but what we do know is the Fed still remains completely clueless and on their path to hike rates. As Fed officials back another hike while watching the bank fallout, well, we're watching it, wondering if it's going to stop. As Cleveland Fed President Loretta Metre, typically among the more hawkish of policymakers, says she favored getting rates above 5% because inflation was too high. And based on the decline in new orders, it's not going to stay high for too long, Miss Metre. But she tempted the message by arguing prudence was also needed because tighter credit conditions could cool hiring and spending, which were also, again, we see this in the Philly Fed data. What did they just say? We're not looking to really hire people. We're seeing prices coming down that we're getting paid on. We're seeing the disinflationary forces. So yes, all these effects from tighter credit conditions are indeed happening. And she said we're much closer to the end of this tightening journey than the beginning. How much further is tightening is needed will depend on economic and financial developments and progress on our monetary policy goals. She's not the only one, as Atlanta Fed President Raphael Bostic is one who said he repeated his message by saying, one and done rate hike approach. He said, is my view. Once we get to this point, we'll have moved firmly into restrictive space, and then I think it's time for us to let the restrictive action work its way through, and that will take time. And based on what we're seeing, well, Raphael, we're a lot closer to seeing this thing collapse, according to me, the economy, and unemployment to surge higher and inflation to come down than you may realize. What this means on May 3rd, at least from what we're hearing so far, is one more rate hike is in the cards. But I don't know about you, but I think it's far too late, and the Fed should be cutting, not hiking, because what's going to happen is something that they can't even stop. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.